Welcome to Yahoo Finance's flagship show, Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures a little change after the latest batch of economic data showed a pullback in consumer spending. The value of retail purchases not adjusted for inflation was up 0.2% after a 0.6% gain in August. Again, these are September numbers, so they are dated numbers. Meanwhile, wholesale inflation data showed a moderate increase month over month. It's a positive sign for the Fed's fight against inflation and a December rate cut. Stocks have been volatile as investors debate whether the Fed will cut in the coming weeks. Equities did rebound in the last two trading sessions, with tech stocks seeing their best day since May. Plus, AI competition is heating up. Nvidia shares are taking a leg lower as Google's AI chips challenge the market leader. A new report from The Information says Meta's in talks to spend billions on Google's AI chips for its data centers. Meta may also rent chips from Google's cloud division next year, according to the report. The move will help establish Google's TPUs as an alternative to Nvidia's GPUs. And Alphabet is now the best performing Mag 7 stock this year. Since mid-October, shares have risen 35%, and the stock has added more than $1.5 trillion to its market cap. And retail earnings continue to roll out. Dick's Sporting Goods is sinking amid the cost of turning around Foot Locker, which it bought in September for about $2.5 billion. Comparable sales at Dick's stores rose more than expected, but investors were more focused on Foot Locker-related charges and store closures. Meanwhile, both Best Buy and Kohl's raised their full-year outlooks. It's the second quarter in a row that Kohl's has lifted its forecast, a sign of stability under the newly appointed CEO, Michael Bender. Let's get a check-in on stock futures right now. We're seeing a mixed picture at the moment. NASDAQ futures pointing to a small decline of about 0.25%, probably weighed down in part by Nvidia, counterbalanced to some extent by Alphabet. S&P futures, little change. Dow futures, little change to the upside. So let's dig into our top stories of the day now. Nvidia falling after a report that Meta is considering using Google AI chips. And a look at fresh economic data with retail sales and the producer price index, plus the biggest takeaways from Best Buy and Dick's Sporting Goods earnings. Joining me now, markets and data editor Jared Blikre, Federal Reserve correspondent Jennifer Schonberger, and senior reporter Brooke DePalma. Jared, let's start with you because the trajectory of Alphabet as of late has been, dare I say, nearly Nvidia-like.
Yeah, it kind of reminds me of Nvidia a couple of years ago. And if we go to the Wi-Fi Interactive here, I've got some interesting stats for you and some interesting charts. So behind me are all the top market capitalization stocks of the S&P 500. This is what happened yesterday, where you see Google was up 6%, Broadcom in the upper right up 11%. Let me put on the pre-morning quotes first so you can see, as you said, Julie, Nvidia down in the upper left, down about 4.52%, but Alphabet up another 3.69%. Broadcom up a very similar amount. And let me just show you how some of these stocks compare to each other, and then I'll show you in terms of market cap. So this is going back 3 years, compares Nvidia to Alphabet. Nvidia up 1,000%, so that is 4 digits right there, versus Alphabet's very respectable 223%. Clearly Nvidia trouncing it, but you put on the year to date and you can see they were on a pretty similar trajectory until recently. Then they have diverged. So Alphabet now up almost 70% here, while Nvidia up 35% or so. And then if you compare Alphabet to Broadcom, another stock that has just been flying, Alphabet is just barely outdoing it. So Broadcom at 63% versus Alphabet's 68%. So Broadcom, another one that is going Nvidia, so to speak, to use your terminology. Now I want to compare Nvidia's market cap to Alphabet, and I have adjusted Alphabet and Nvidia so that they hit $3 trillion on the same day. So that's what this X timeline, the horizontal timeline is. And you can see right at this dividing mark, right at the zero mark, when Alphabet hit $3 trillion, it is surged now, and it is very close to getting that to that $4 trillion mark. In fact, by my calculations, if we were just to linearly extrapolate, it could be there as early as next Tuesday. But based on what it's done over the last few days, it could get there today, it could get there tomorrow. So I wouldn't be surprised to see those headlines. All in all, it just kind of highlights how fast Alphabet has been up and coming in terms of its performance. When we recently had a slight market correction, Alphabet was one of those stocks that just went sideways. So that is a clue that it has a lot of stability right now, that there's a lot of people buying those dips, a lot of institutional as well as retail interest in this name.
And what's so interesting also is that when Nvidia sort of began its journey, its spike following the introduction of ChatGPT and the surge in sales of its GPUs, I mean, it wasn't a small company, but it wasn't as big, right? To your point about sort of where they were relative. So it's just extraordinary to see a company the size of Alphabet, the velocity of the gains that we have seen. Jared, I want to broaden it out and also ask you about seasonality, because we're getting to the end of November here. What do we need to know about what December tends to be like for markets?
Well, fortunately, Decembers tend to be quiet, and I think investors could really use that. So let's take another look at the Wi-Fi Interactive behind me. I'm going to put a year-to-date chart so we can see the S&P 500. Year-to-date up 14%. From that bottom that we saw several months ago, up 35%. So you can see this latest, what we would call slump, not even a correction. That's usually 10%. This was about half of that, barely a blip on this. Now, December is generally the third best month for the S&P 500. It's a little bit better for the Russell 2000 for small caps. Small caps tend to outperform December, January, February. But when the market is already up as much as it is at this time of year, we tend to get a little bit of consolidation in the first half of December. So we might not expect to get that year-end rally until maybe the back half of the month. Having said that, anything can happen. If you remember 2018, that was the worst December since 1931. We had almost a bear market. We came to like 19% and change in the S&P 500. Nobody's expecting that for this year, but just goes to show you there can be some curveballs from time to time. So if history repeats itself, we should expect a couple of weeks of consolidation after this week, and then maybe moving up and enjoying that Santa Claus rally at the end of the year.
We'll see. Fingers crossed. I don't know. And let's talk about more of the retail earnings that we got here this morning, Brooke, because it's an interesting picture added to all of the other information we've been getting from the retailers. Let's start with Best Buy and what we heard from them.
Julie, what we heard from them was that this was the highest report for same-store sales growth that we've seen in nearly 3 years. Same-store sales growth was up about 2.7%. And this was largely led by a consumer returning to the store for the first time in a while. And that was largely led by customers' need to replace and upgrade products. This is something that we've been waiting for, this inflection point that we've been waiting to hear from Best Buy for quite some time. And that was largely led to strength in the computing. Think of those mobile phones. So we got that new iPhone just earlier this quarter. And so that certainly led to some momentum there. And on top of that, too, this gives the company the confidence to raise their full year outlook. They now said that they do expect same-store sales growth to increase rather than see a decline for the fiscal year. They also expect to see some momentum heading into the fourth quarter, of course, that crucial holiday season. And what we're hearing on the call is that they said at the high end of their Q4 outlook assumes growth in those three categories that have and continue to do well: computing, gaming, and mobile. Think about that Nintendo Switch 2 that also came out earlier this year. They also said that the Q4 outlook includes improvements within their TV business. They said that that was driven by pricing, also increased marketing, and improved delivery and installation. And so there's lots of different factors that the CEO there, Corey Barry, has been trying to get into play. And it seems like this quarter, they just about got over that hump.
And let's talk about Dick's as well. Is Dick's an interesting one because comparable sales at the Dick's stores were actually pretty good, but it's being overshadowed by this Foot Locker acquisition and I guess the baggage around that.
Julie, that $2.5 billion Foot Locker acquisition that closed during this quarter on September 8th or prior to. And with that being said, a lot of investors are a bit skeptical about how this will all play out. That's why you saw the stock move down about 8% in pre-market trading. Now it's down about 3%. But the company said that they plan to incur a pre-tax charge of about $500 million to $700 million. The call's still underway, but CEO Edward Stack saying that they've identified an initial number of underperforming assets around the globe when it comes to Foot Locker, including inventory that needs to be marked down, as well as stores, underperforming stores that also need to be shuttered. And so certainly that caught investors' attention. Of course, this is supposed to be an incremental growth factor for Dick's Sporting Goods, but it seems like it's going to have to take a while for ultimately to see that return. They said that they have the wrong inventory, that they didn't move fast enough to direct to consumer. And so all those factors really playing into the outlook for Dick's Sporting Goods. But despite that, the company did raise its outlook because its primary business is doing well. They now expect sales to increase between 3.5% to 4% for the fiscal year. And they said that the consumer right now is really focused on sport and they're willing to pay up for innovation.
Okay, and then let's talk about, let's zoom out, I guess, and look at retail sales overall, although we're looking at them for September, Jen, but still, what did we learn?
Yeah, a bit stale there, Julie, but retail sales did cool in the month of September after stronger spending in August, suggesting that the consumer pulled back at the start of the third quarter. Granted, this is a first reading, so first blush, it's 2 months old, beginning of the third quarter. We could still see revisions, but that sort of points to slower growth in the third quarter. And what stood out in this report is I want to draw attention to the control sales, if you will. That's sales excluding autos and gas. And that only increased by 0.1% versus 0.6% on that same metric for August. So this feeds into the narrative of, was the economy slowing? How does that juxtapose with the stronger job growth numbers that we saw for the month of September? And yet you heard Brooke talk about how retailers have been turning in stronger third quarter reports from Best Buy to Walmart and Gap. So discretionary spending is still happening in this economy. So I don't know how much signal we can really take from this report. Certainly it helps the doves on the Federal Reserve Committee.
Okay, and what does the PPI, producer prices, wholesale inflation, in other words, what do those numbers do for the dove versus hawk debate?
Yeah, so I would say, again, this is September data, so this is a bit dated, but if we look at that on a core basis, it did come in cooler than expected. So looking good for September, excluding those volatile food and energy prices. It was only up 0.1% below expectations for up 0.2% year over year, 2.6% versus expectations for 2.7%, which was down from 2.8% in August. And this is good news because if we rewind the clock back to the summer, remember PPI was really heating up and we were sort of scratching our heads going, are businesses going to be passing on these increase in prices to consumers? The fact that it did pull back in September from the summer months is good news. Granted, it's just 1 month. 1 month doesn't make a trend, but it does help the narrative for the doves on the committee. Definitely keeps a rate cut in play for December.
All right, the debate continues. The market's already made up its mind, by and large, thinking that a cut is going to happen, but we have to wait to see if they're right. Jared, Jennifer, Brooke, thank you. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Time for some of today's trending tickers. We are watching Alibaba, Spotify, and Abercrombie & Fitch. First up, Alibaba, China's e-commerce giant, out with earnings, and the company posted better than projected 34% growth in its pivotal cloud business. The numbers highlighting the enormous demand for computing amid China's AI boom. The cloud growth helped propel revenue to $35 billion for the quarter. Next is Spotify, the audio streaming giant, reportedly going to raise prices on its U.S. subscriptions, according to the FT. That would mark the first price increase in the U.S. since July of 2024. The increase would go into effect in the first quarter of next year. According to Bloomberg Intelligence, a $1 boost on individual plans could add $450 to $500 million in annual revenue. And Abercrombie & Fitch, those shares are jumping as the retailer boosts its sales outlook. Strength in its Hollister brand helped the company lift the low end of its full-year sales outlook. Sales at Hollister jumped 16%, helped by strong back-to-school demand. The move shows that the retailer is hanging on to momentum of recent years under CEO Fran Horowitz. Those shares up 16%. Yesterday's rally aside, investors are facing the most unsettled market since April, with much of the current concern focused on volatility in the AI trade. So it's worth talking about where investors should look outside of AI. Joining us now, Mark Hackett, Nationwide Chief Market Strategist. Mark, good to see you. So I guess, first of all, set the scene for us in terms of your thoughts on the recent volatility around the AI trade and whether you think it's warranted.
Well, volatility has been elevated everywhere. We've had 6 1% moves this month for the S&P 500. That compares against 4 for the entire period between May and October. So investors are a little bit edgier. Breaking through that 50-day moving average was clearly a catalyst for that level of volatility. But as you mentioned, the AI space and certainly the Magnificent Seven are no longer trading in a homogenous type of fashion. We've seen Nvidia break down here a little bit, obviously Meta as well, and on the other side of that, Google, so Alphabet. That trade is very different. Investors are still very reactive. The buy the dip instinct is huddled very much towards that tech AI space. For example, as you were alluding to, NASDAQ had its best day yesterday since May. But at the same time, we're seeing a little bit of a change in investor behavior. And I think that is going to lead to this more democratization of returns and shift in leadership going forward.
So do you think that investors need to be a little bit more choosy within the Mag 7 and within the AI trade than they have been? I mean, it feels like there's been a lot of like buying the whole thing.
Well, certainly we have more avenues to do that today than we ever have in the past through ETFs and otherwise. But there has been a coordinated purchase decision around the AI space, even beyond the technology names into the power names and elsewhere. We certainly agree that going forward, both the valuation gap but also the narrowing of growth expectations between that tech space and pretty much everything else in the economy does warrant a more selective approach, not only within the technology space, but broader within the S&P 500 and elsewhere.
So let's talk about then where people should be looking outside of the AI trade or sort of the like direct AI trade when we're talking about big tech, Mark. What other sectors would you be looking at? I mean, there's certainly a lot of laggards this year to pick from, but just because something's lagged doesn't mean it's going to do well next year. So what are you looking at? What are you thinking about?
Well, we look at the macro picture, and it's been much more resilient than had been feared, and also the earnings trends that over the last couple of quarters have been very encouraging. So we're looking at areas that have been largely forgotten from a valuation perspective, like financials, like industrials, and also small caps, areas that are pro-cyclical, a little bit risk on historically, but haven't necessarily done that in this cycle and certainly this year. So we are in the optimistic camp, but we'd be much more oriented towards the risk reward group that has higher upside. And we think, the groups that are in the low to mid teens valuation that are expected to grow in a, double digit type of pace next year, that's the areas where you'd be looking.
And how reliant are those areas on a Fed rate cut? And does it matter if it starts or resumes, I guess, in December or in January and beyond?
Well, the December rate cut, as you know, is much more, about a signal than it is about that 25 basis points per se. Those small cap space and certainly the financials have been very reactive towards movement in Fed funds curve. And the fact that we're up almost towards an 80% type of expectations for December is certainly a tailwind for that group. But this is more of a broader call. It's the fact that the rest of the globe is starting to accelerate. We're seeing 4% type of growth within the GDP in the third quarter, double-digit growth across the S&P 500 in terms of earnings. So there's a lot to like for the macro picture. And then as you get into next year, you have the fiscal and monetary tailwinds, the benefits from the weakening dollar, and then also a lot of this 250th anniversary type of events, such as the World Cup. Those are all stimulative type of action. So it's not just the Fed, although the Fed is obviously a lot of the measuring mechanism for the risk on trade.
Mark, the signs on consumer spending have been pretty mixed, judging from the individual retailers. So how do you think that's going to sort of behave through the holiday season and into next year?
Yeah, obviously the lack of data from the government is a bit of a challenge. So we do rely a little bit more on the retailer reports on earnings. But those are always a little bit choppy because there are winners and losers in that space. Overall, we see the consumer as incredibly resilient with a little bit of choppiness around the government closure. But certainly trends have been pretty optimistic within the consumer. Interestingly, though, there's a tremendous divide versus what people are saying versus what people are doing. We've seen that consumer sentiment number at historic lows, but at the same time, people are spending, real wages are relatively healthy. A lot of the fear around the breakdown in the employment market is shown to be a little bit of an exaggeration. So we see fairly healthy consumer spending trends, certainly in the higher end of the demographic wage earners. But across the economy, consumer spending has been remarkably resilient.
Mark, good to see you. Thanks a lot.
Thank you.
Coming up on Yahoo Finance's opening bid, our executive editor, Brian Sozzi, is joining us now. A little teaser, a little preview. What's coming up?
What's up, Julie? Yeah, lots going on in the show. We're going to dig into Google's. Now it's knocking on the door of a $4 trillion market cap. Have a stock of the day, of course. Question of the day focused on markets. And lots going on, Julie. Lots going on.
Do you notice
so much I can't even get out of my head.
Do you know what color you notice what color I'm wearing today?
You're wearing pink. I got blue. Somewhere there's a holiday message in there.
I guess that is blue. All right, that does it for Morning Brief. Much more ahead on Yahoo Finance.